Would you believe it? Another hedge fund just blew up. 10-year yields are back to their recent highs. Gold melting down again, and quarter-end rebalancing flows are going to keep these markets choppy. All this and more in this week's Macro Insight. Okay, guys, welcome back to Macro Insight. Today is March the 30th, and let's have a look at markets. So, market action last week, very choppy market last week. So we had, a bunch of things going on. I would say that the hedge fund liquidation, that's been all over the news over the last few days. So a hedge fund called Archegos, I don't know how to pronounce it. Basically, that's being blamed for the sell-off that we had on Friday, the intraday sell-off that took the S&P down to like 3850s kind of levels. And basically there's about 20 or 30 billion in equity block trades that were being unwound as this kind of fund hit margin calls and basically needed to be liquidated. Okay, so as that news came out over the weekend as well, markets began on a weaker footing over the weekend, and it turns out that Nomura shares were down something like 16%. Credit Suisse also taking a big hit, so wiping out a chunk of their earnings basically for the last sort of 3 to 6 months because of losses associated with these positions that this fund had. Okay, so it does seem though that the damage so far has been contained and it hasn't really reverberated across markets. So it seems quite localized, and the S&P managed to pop back up and close very close to its highs yesterday, right? So, we've kind of, the S&P has been very resilient. The kind of back and forth last week seems like we've been caught between quarter end selling flows that I've been mentioning, where equities have done well, bonds haven't done well, so the rebalancing of various funds is going to mean quite a lot of equities to sell and buying of bonds. But then on the flip side of that, you've got quant driven buying. So you've got a guy called Charlie McGilligot out of Nomura strategy, and he talks a lot about this. So you have various funds that are kind of vol targeting funds, vol control funds, whatever you want to call it. And they basically base their exposure and kind of how much they buy and how much risk they're allowed to take. They base that on the volatility levels. And they have various volatility, they have various windows, look back windows for how they calculate that volatility, right? So if you look back over the last year, the big dramatic swings of March last year have dropped out of that look back window. Okay, so that means the realized vol for the last year has just suddenly shifted down because it's taken those big 10% swings back from last year out. So that basically means that these vol control funds can add leverage and add risk to their portfolios. So they basically have incremental delta to buy because volatility is not as high as it was, right? So this is one impact, which is going to actually bring buying flow to the market and has been bringing buying flow to the market over the last week and will probably continue to do so this week, right? So that kind of counteracts some of the selling from quarter end. And then in general, a lot of money managers use VAR calculations, which is value at risk, and they look at that 1 year look back window. And so it may well be that a lot of people's VAR has dropped down because those big swings have been taken out, and it can basically give money managers a bit more risk appetite than they would have had a few weeks back, just based on their models telling them how much risk they're allowed to take, right? So there is definitely some support that's going to come to the market from that type of thing going on, right? As people use look back windows to measure the realized vol, and then that impacts how much exposure they're allowed to take on risk. Okay, so that should kind of add to the bullish setup going into Q2. All right. So let me have a look. Let me share the chart on that. Right, so there we go. So there was the S&P. So you saw that's the 4-hour charts. You saw we got back up, but pretty close to those highs at 39.90, and now we're drifting back again a little bit, right? But I mean, in the context of that, we're pretty much at the highs, right? Within less than 1% away from those highs. So S&P proving to be bulletproof. Tech, however, still remains quite heavy. So if we look at NASDAQ, you know, that's really been struggling to recover, okay? But, you know, the reason for that obviously being 10-year yields, right? So if we bring up the yields chart, you can see 10-year yields pretty much, I mean, they were earlier this morning at their highs at around 177, drifting back to 175, but that, I mean, that is showing no signs of really pulling back, right? We had mentioned last week that yields may take a breather for European and Japanese kind of investors. Fixed income in the US is looking quite attractive on a relative yield basis, even when you take into account the FX hedging costs. That doesn't really seem to have done it any favors still, right? So those US bonds still seem to be under pressure. And, you know, we saw those auctions go through last week, the 7-year auction not being spectacular, right? So keeping pressure on yields and you know, now we're looking at that 2% area, it doesn't really seem very far away, right? So very realistic that as the summer months come, we will most likely see a 2 handle on that 10-year yield, and that may well continue to provide headwinds for the likes of the NASDAQ and tech stocks, particularly the speculative kind of low earnings, long duration type tech stocks, okay? Now, one slightly more surprising thing maybe is what the Russell's been up to, right? So small and mid caps had been kind of leading the charge since last November, since the vaccine news dropped, and you know they've been part of the value rotation, etc. But even though the S&P's managed to recover nearly back to its highs, I mean the Russell is, you know, a good 10% off its highs. So Russell's definitely going through a period of consolidation. You know, I think, you know, there's been some talk of the US states maybe delaying some of the reopening as COVID cases are spiking. So that may be weighing on the sector a little bit. I mean, I do think, though, that's going to be temporary because, you know, if you look at what's going on in terms of COVID, the US are accelerating the pace of vaccine rollout. It's going strong. I think it's something like 3 million people a day are getting vaccinated in the US. And then CDC had a report out showing that they've done a study on the sort of real life vaccines using, you know, recent samples of people who had their first jabs. And, you know, it's showing very good results in terms of cutting transmission and preventing illnesses. So, you know, I do think it'll be quite short-lived, any of this weakness on the back of people worrying about COVID cases spiking, right? It's kind of normal for COVID cases to kind of go up and down, but with what's going on with these vaccines, I suspect it will be quite short-lived, that spike, right? So Russell consolidating. To me, it looks like a bit of a textbook kind of pullback right now. So if you look at it, had an amazing run from like 1550 all the way up. So if you called that some sort of third wave in Elliott speak, we're doing a fourth wave correction now. So an ABC correction where we could well be at the later stages of that C wave. Whether it's ended already or whether it's going to touch those lows again. I mean, looking at around 2100 looks quite attractive to enter. Maybe we push down to 2000 at a push, but that's probably going to be a nice entry point for the Russell over the sort of midterm. Yeah. And then lastly, kind of some of the other sectors that have been charging in the US, like the financials, they had a little bit of a pause, but they still look very much in a strong uptrend. Same with the energy sector. XLEs, very strong uptrend, had a bit of a pause along with the oil price, but now continues to kind of, you know, work its way up basically, right? So that's kind of what's been going on in US equities. then the last point really on US equities is where's the stimulus checks bid, right? Everyone was going on about stimmy checks are coming, they're going to get piled into the market. And if that really is the case, we know that the retail guys tend to like buying those spec techie names, the retail favorites, those meme stocks as they're called. So, you know, Refinitiv did a survey, and I can share this screen with you on that. This survey was done. What are your plans? What are your plans to do with the stimulus money? So basically the numbers were coming back as save the money 48%, pay down debt 32%, spend it 15%, and only 5% invest it, right? So that's quite a dramatic reduction compared to maybe what we were seeing from previous stimulus checks in the last couple of rounds. So we had obviously in whatever, December, January, and then again in last summer. You know, maybe that money doesn't find its way into the stock market, right? And you know, based on what we're seeing in terms of the performance of ARK, it's kind of languishing, right? It's pretty much at its recent lows, right? So, you know, not really, doesn't feel like we're seeing that stimulus money pile into the market, right? In terms of that evidence, yeah. I would also say another interesting thing about ARK is, so on Monday, on Friday, they made some amendments to their prospectus, right? So last Friday, they made amendments to their prospectus, allowing them to become even more concentrated in their holdings, okay? So they, you know, we said that their kind of style was when the market's selling off, they liquidate their large cap holdings like their Teslas or whatever, and they switch into their really illiquid small cap stuff that's getting beaten up even more. Adding fragility to their portfolio, basically, right? So they think it's added. They think they're taking advantage of opportunity, but any risk manager who's ever traded before will tell you that that's not a very clever risk management sort of idea, right? To put more illiquid stuff into your book when the market is going down is a bit dangerous, right? So for me, the fact that they're having to change the prospectus to allow them to do this stuff is a bit worrying, and to me it just sounds like it's adding further fragility, and it sounds like an accident waiting to happen, right? So I'm not saying they're about to go pop imminently, but the way the way that they are handling drawdowns and the way they're managing their risk in the face of drawdowns is a very worrying sign, and would therefore at some stage, maybe it's later on in the year when yields spike through 2% or whatever it is, I wouldn't be surprised to see a pretty disorderly unwind of maybe a lot of their holdings, right? So that could open up like a correction in this ARK ETF down towards maybe levels closer to 80, 90 versus what it is now, right? Which is another 20%, right? So I don't think that's going to happen imminently. Like, I think we're getting quite close to this recent down. I think we're getting quite close to the end of this recent correction. But for something a bit further down the line this year, I think that's definitely something to be aware of. And it is concerning. It's not a good way to manage risk, in my opinion. Yeah. Okay, so that's kind of US equities and what I've been seeing there. If we look across to Asia, I mean, it does seem like the liquidation of the hedge fund was kind of more localized for Chinese names, particularly Chinese tech names. So it looks like a lot of that sort of those block trades and the dumping of those assets has been done in that space. And a good place to see that is the KWEB ETF. Yeah, so this is the KWEB ETF, right? Which is like Chinese internet stocks. So you see it's obviously had a big old wobble from the top there up at, it got above 100. But now, you know, given that we know that a lot of this liquidation flow has been coming in this space, we know that China have let some of the steam come out of their market. They thought it was a bit frothy, so they're happy to let that happen. Now, you know, China may be becoming a bit of an opportunity to buy the dip, because if you look at this, I mean, you're getting some potential divergence here. So if we bring up the daily chart on KWEB, so China's looking oversold. You've got lower lows from sort of early March here that were made, whereas you've got bullish divergence, right? So you've got momentum making higher lows whilst price making lower lows. Always a nice sign if you're thinking about buying the dip. And then another thing to kind of bear in mind is sentiment in China, right? So here you've got China minus global sentiment, right? I can't remember which bank put this together, but basically it's an index trying to track sentiment. And Chinese sentiment is kind of as low as it's been in a decade, right? Relative to global sentiment, okay? So that might be saying that might well mean that there's an opportunity to buy the dip in China, at least in the short term, right? Whether China kind of continues to deteriorate over the coming months remains to be seen, and what their government want to do. Personally, I think they're kind of just playing it a little bit and gaming it a little bit in terms of they've got this big anniversary coming up in July in China, where they will probably want to have some bullets if they want to stimulate and make things look good and rosy basically around that sort of time. So maybe they're just letting some of the froth come out of their market now to just then reflate it into that. And that you know, if you look at past occurrences when they have these type of anniversaries or whatever is going on, that they do kind of like doing that basically, right? So that's my suspicion. But I think in the short term, China feeling a little bit oversold. So that's kind of what's been happening in equities. Coming up this week in terms of data, we've just had some inflation data out of the EU, which is kind of in line with consensus. We've got China PMIs tomorrow with ADP employment data. Thursday, we've got Japan Tankan survey, US ISM manufacturing, PMIs, OPEC meeting, which will be important for oil prices. And Friday, we've got non-farms, but Friday's kind of markets are closed for Good Friday. So we'll see what the non-farm number is, but most of the market activity is going to happen next week on that. Okay. In terms of commodities, obviously the Suez Canal story was interesting. That blockage lasted for, you know, best part of a week. They've managed to clear it now. So, and you can see in the price action in oil. So you had oil was selling off. Just generally, oil was correcting on some inventory data and on the idea that the vaccine, you know, not the vaccine, the COVID cases were spiking and stuff like that. So you had a bit of a wobble. Then you had a strong bounce in oil on the back of what happened with the Suez Canal. And now we're kind of chopping around, but really pretty strong uptrend in oil, still intact, I would say. But, you know, it's a volatile beast, oil, right? I mean, it can do $3 or $4 in a day quite comfortably, right? So it's winging around. But I suspect this uptrend is going to be intact. You know, I picked up some in the kind of 58 area, planning to hold on to it for now, to be honest. Like, we may have some more consolidating to do in the short term if commodities in general are weak, but I feel okay about owning a bit of oil now, right? So the OPEC meeting, obviously this Thursday is going to be big. They're talking about rolling over the production cuts. That's kind of the base case. So we'll see if it moves much on that. It probably doesn't. But if anything, they don't want to see the oil prices collapse, right? So they're going to probably say it will be fairly supportive in general, I would imagine. Yeah. So that's kind of it on oil. Now, before we talk about the other commodities, I thought this was quite an interesting graphic by Bank of America. Yeah. So this is a look at real assets relative to financial assets, right? So what they're calling real assets is a blend of commodities, real estate, and collectibles versus financial assets, which is large cap stocks and long-term government bonds since 1925, right? So this is what they've basically done, and they've tried to put a few markers on there for what was going on in the world over that 100-year period, right? But you can see real assets relative to financial assets are at rock bottom in the last 100 years, right? So I would say that gives you some idea of the relative value between those, right? And so the way I kind of look at that is to say, well, that just means that if you were a 60-40 type investor, 60% equities, 40% bonds before, then it's kind of a no-brainer at these levels to be switching some of that bond portion, which you may be nervous about anyway, in the face of potentially higher inflation, right? You know, you should be switching some of that 60-40 into as maybe a 60-20-20, where you go 20% bonds and maybe 20% real assets, right? Real assets being, you know, commodities, real estate, collectibles, whatever it is. So that's kind of I've been kind of doing that in my long-term pension portfolio for a while anyway, because I'm a fan of commodities and real assets. But, you know, just adding more sort of weight to that argument if you look at where things are on a 100-year sort of time horizon, 100-year history. Yeah. All right, so that was just an interesting one. In terms of the more specifics, gold. Obviously, happy to see this sell-off resume. I had been saying, you know, I think we're going to get a retest of this 1680 as a minimum. I actually fancy we're probably going to break it. But, you know, remains to be seen, right? We're retesting it. The momentum indicator, the daily momentum indicator, is not quite as low as it was on the last test. So that opens up the way for maybe a bullish divergence if it can hold these levels. But if it accelerates through these lows and picks up downside momentum, then, you know, I've been saying that I think the next kind of area of support is going to come in more like around here, 1570. Yeah. So I think there's a risk of that because, you know, I do think I think gold is one of those assets where you can get quite a lot of lazy longs, right? People just see gold as a safe haven. They buy it and they buy it quite lazily and they don't really manage their risk that much, right? So they might just, you know, 1680 might be a catalyst for people to throw in the towel a bit who've been lazy longs for the last 3 months thinking, oh, it's gold, it'll be fine. And now they're going to look at the chart and be like, that opens up the way for some quite big sell-offs. Maybe I need to get out of this, right? So there might be a bit of a panic move that takes us to 1570 if this level breaks. That's kind of how I'm looking at it, right? In terms of, as I said earlier, in terms of how I'm playing it, I've been selling delta on that uptick that we saw around up to 1755. I've been covering bits of that delta down here. I also bought some puts, which I'm going to hang on to. They don't expire until sort of end of May, so plenty of time for them to have their pop. But yeah, in general, I'll run a tight leash on my delta exposure here, but I'm going to run my puts basically because I think that if you get the explosive breakdown, then those puts are going to like triple easily in value, right? So that's kind of what I'm looking for. Yeah. So that's gold. Silver's also been heavy. Nothing really different to say on silver. I mean, I think a 23 handle on silver is very realistic. I'd probably start dipping my toes in on tactical purchases around 23 because, you know, I think silver's, you know, it can be quite high beta in both directions, right? So if you've got some puts in gold, for example, and you've got a core bearish position in gold and you do reach quite oversold levels in silver, then picking up some scraps of silver against your gold shorts works quite nicely as a tactical way to play that bounce, right? So that's kind of how I'm looking at it right now. So I'm on the lookout for those sort of levels at around 20, low 23s to maybe pick up some silver. Yeah. On other commodities, we've got copper. So copper's been in consolidation mode for a while. You know, China started kind of slowing down, rolling over a bit. The Chinese credit impulse, as we've mentioned, is the leading indicator for commodities. That was showing some signs of weakness. So commodities have been correcting, but nothing too sinister, right? If you look at where copper is, it's really struggling to gain any major downside momentum below sort of 4, right? So yeah, I had carved out some retracement levels, and I was thinking that 377 was a good place to buy where this correction might kind of end itself, but it's really struggling to break 390, right? So I don't know whether we're going to get it. I mean, I added some more copper to my long-term portfolio today because I just think the fundamental story is just too good for copper, right? So I felt underweight, so I'm adding to that because I got out of all my gold. I went quite heavily into cash. And now I'm kind of thinking, right, I want to buy things that I like on the longer term. And copper is definitely one of those things, right? So copper, nickel, all those sort of metals, I think have got a decent potential. They may well have some more correcting to do. But if that happens, I'll happily buy more for my long-term book. So I'm not in like any tactical longs right now that need to have stops associated with them. But down at 377, I'll probably put some tactical longs on for copper as well, if we manage to get there. Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our Summer Academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.